Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. All right, so it happened. Inflation actually went down a little bit, and it went down more than what we expected. So in today's video, we need to figure out, what can we learn from this? Does this mean that we should see less growth in 2023? Are things going to slow down a bit? Like, what does all of this mean? So let's quickly go over it. So first, we found out this morning that inflation came in at 7.1%. Yes, still historically high. However, things are slowing down a bit because the last report had us at 7.7. The report before that had us at like 8%. So things are starting to slow down. The result of this was primarily the cost for gas has dropped significantly in the last few weeks. That helped, but there are also other spots where things are starting to slow down in terms of the pace that prices had been increasing. But with that, right, if inflation is coming down a bit, people are spending perhaps a bit less, and depending on how you want to look at that, we can kind of go into that in a second. But if inflation is coming down, rates are going up, and the purpose of raising rates is to slow people down from making big purchases like buying a home, buying cars, borrowing money, especially for smaller tech companies or even larger tech companies. So, hey, you need to pull back. You might have to let some people go, which is really unfortunate because you cannot afford to borrow money at these rates out here, right? So does that mean that in 2023, we should expect slow to low growth? Like, will the economy just kind of flat out stagnate and we're just going to be in just a cycle of not really doing anything? First of all, that's a great question, okay? But second, there are a few mechanisms in place to not necessarily stagnate. What the Federal Reserve is trying to do is raise rates just enough to slow things down without stagnating, which is why tomorrow on Wednesday, the 14th, we should expect the Federal Reserve to come out and raise rates by 0.5%, as opposed to the 0.75% they have been doing for the majority of this year. That is basically them saying, look, we were being super aggressive to slow things down. However, we don't want to stagnate. We don't want to crash the economy. So we're going to step it down just a bit and still raise it, but by just 0.5%, or what they call 50 basis points. That is the goal. Now, will it work? Don't know. How will the market respond on Wednesday? I don't know, because the market can do whatever the market wants to do. The market can say tomorrow that, this is an appropriate decision and we think that you are stewarding the economy in the right way. You're not going to crash everything and the market pops. Or it can say, hey, that's not aggressive enough and the market can tank. I don't know. Honestly, I don't really care what happens tomorrow. Y'all know I'm dollar cost averaging on Friday anyway. Okay. However, what we expect for 2023 so far, I'm going to do way more videos as we get closer to 2023 near the end of the year, which is like 2 weeks. But once we get there, I'll do a deeper dive here. However, even though interest rates are going to continue to climb, currently the expectation is that the Fed is going to continue raising rates all through 2023. Now, the magnitude of those rate hike increases is probably the most important thing. I don't know right now, is it going to be back at 0.75? Is it going to be 0.5, 0.25? I have no idea at this point in time. However, we do still expect the economy to grow to a degree, okay, to a degree. And we say that because, number one, last quarter we had for GDP, gross domestic product, the value of all the stuff that we produce, that was positive in the most recent quarter. And we just added 263,000 jobs to the economy. So we are still growing, and the expectation is that we would, assuming everything stays the same, we would continue to grow in 2023. However, we may not see 200,000 jobs or 250,000 jobs added. Perhaps that starts to shrink. And I think that's the goal of the Fed. They want that to come down just a bit, where people are still growing and people are still getting hired, but not necessarily, zero or even negative, because you don't want to push people into unemployment. You definitely don't want to do that. And you also don't want to push the entire economy into a recession or anything more serious than that. So they're trying to strike that balance, which is very difficult for a few reasons. One, you only got one tool in your toolbox, or at least one main tool, and that's raising interest rates. You really can't do much else. That's all the Fed can do. Now, can Congress do some stuff? Yes. Can Congress be effective in doing those things? No. So the Federal Reserve is our only hope in this case. And the other side of this is, again, they're trying to find out what is the perfect balance and how do we keep things together? The other part of this too, which, it puts us in a weird scenario where this market and this economy is great for people looking for jobs and for individuals, because we still have 1.7 jobs for every one person. Ideally, at least for the Fed and for inflation, you want that to be 1-to-1, so that every one person has one job that's open, y'all can get that job, and that's going to be it. So far as it's 1.7 jobs for every one person, then we can negotiate for jobs, we can ask for higher salaries, which again is beneficial to us. However, when the companies have to pay more, they pass on those costs to people like me and you, and then we all pay higher costs across the board for inflation. So again, it's like a catch-22. I want you to get paid more. I want to get paid more. I want everybody to win. But you want to bring that down just a bit so that inflation comes down and they can start to cut costs in terms of what we are paying, whether it's at the gas pump, the grocery store, and wherever else. So we can still grow even as interest rates rise. However, the key goal here for the Fed is to grow slower. Is to keep growing, but grow slowly or slower is their main cause here. Remember that their their goal rate, their target rate is usually like 2 to 3% per year for inflation. That is what they are trying to get to. And again, we're at 7.1. So we are still quite a ways away from that particular mark, but at least we are, I wouldn't say cruising to it, but we are slowly inching towards that goal. And we'll see what happens in 2023 in terms of how aggressive they are going to continue to raise rates in 2023. I may have mentioned it before, at least if not in this video, in a previous video, that it is expected that they are going to raise rates all through 2023 with no breaks. Now, the question is rather, is it going to be 0.5% or 50 basis points, which is what we expect to hear from the Fed on Wednesday? Or in 2023, could they go back up to 0.75? Could they go down to 0.25? That I don't know. That I have no idea. I'm not going to pretend to know. I have a crystal ball on what they're going to do in 2023. But as we get closer to those dates, they will usually announce these things in advance. We knew, for example, they were going to cut things or slow things down. We did a whole video on it in advance that they were expected to do a 0.5% interest rate increase. So the market has started to adjust to this already. I don't know what the market is going to do tomorrow. However, in 2023, the goal here is still to grow, but at a slower pace. So again, maybe not 263,000 jobs are added. Maybe it's, I don't know what the perfect number is going to be. Maybe it's 50,000. Maybe it's 100,000. Whatever it is, their goal is to say, yes, keep growing, but just grow a little slower and keep everything on track. So I don't really see us stagnating, or at least that's not the goal for us to stagnate, because that puts us in a situation that we don't want to be in either. But again, slower growth is what we're looking for, and that's what we can learn from the inflation numbers right now. Yes, interest rate hikes are working. They're slow. They're extremely slow, but they are working. And there are a few areas in the economy that really need to get fixed in terms of supply. Food costs are still high. Energy is still high. And we've got to find a way to kind of, offset those prices. Some of those things are easier than others. Oil with OPEC, that's one thing. Food is one thing. The supply chain, which has loosened significantly from what it was last year, is still something that takes forever to fix. For example, there was a report in Apple about Apple where they need to rebuild, kind of move things out of China and rebuild them in other areas. For them to move their entire operation from a mega plant in China and relocate, whether it's here in the US or Taiwan or anywhere else in the world, we're talking a decade for those plants to be fully operational and produce the exact same amount of goods. So that's the other half of this. We're only 2 years in for companies that started to solve the problem in 2020, which I can guarantee you, I don't think many companies started to solve the problem for supply chain in 2020. Some people are slow, and also I don't think any of us thought we would still be dealing with this 2 years later. I thought, probably like you, hey, summertime, this thing will be over. And it wasn't, and it just kept going. So, we'll see how companies adjust, but I don't really see stagnation. At least I definitely don't hope for stagnation in 2023. We can still grow, but the goal for them is to grow just a bit slower. All right, that is it for me. But before you go ahead and hit that like and subscribe button. I appreciate that. Leave a comment if you wish. That also helps out the channel. But I'm going to tell you right now, okay? I'm going to tell you, let me check my notes, okay? Because I'm going to tell you this early. If my computer wants to work and not embarrass me in front of 4,000 subscribers. All right, so I have a list that I'm looking at right now. There are 6 stocks that I have that I've kind of pulled these out specifically for passive income. Okay, 6 stocks. All 6 of these are going inside of our members only and will be released later this week. Okay, just telling you now, the link for the members only is right here. Okay, right here. It's $10 a month. We do exclusive videos every single week. All 6 of these are going inside the members only. I'm telling you now on Tuesday. So Thursday or Friday, whenever the list comes out, the members are going to get it. Now, everybody else may or may not get 1 or 2 stocks on the list, but I'm telling you now, the members are going to get this list first. And as I'm glancing at it, I've got at least, I have 1 stock on here that's up 11% in the last 6 months, which in 2022 is great. You know, last year it's up 21%. And it's in the tech sector, which I guarantee you probably have not thought a whole lot about. And when I talk about passive income, I'm talking about dividends here. So all of these pay a very hefty sum. So I'm telling you now, that's all I'm going to say. These are stocks that we have not talked about, all except for one. We have not talked about. I did one about my favorite dividend stocks. These are specific, very specific for passive income. So if you're looking to buy a few stocks and just have those dividends rolling in and just really kind of sit back and chill while also making money in the market, this is the list for you. So you can check that out in the members only. That link will be right here. All right. I'll talk to y'all tomorrow. We will likely talk about what the Fed does tomorrow in terms of interest rates, depending on how that does shake out. And then again, this whole video was because someone had asked a question. So you can ask a question and you too can have a video. All right. That is it for me. I'll talk to you later. Bye.